The post-pandemic wave of immigration has brought vitality, business, and wealth to Australia. But the population surge has also intensified pressure on the Australian property market. People can't afford to buy or rent homes, and Sydney is a prime example. As the city with the highest property prices in Australia, Sydney's property market crisis has lasted for nearly 2 years without any sign of improvement. Last week, the New South Wales government took a crucial step, deciding to build the first 3 mini-cities within Sydney, marking the beginning of a high-density, large-scale development era. Is this good or bad for ordinary people and property investors? How should we respond? What are the problems with apartments? Why did an investor who bought 8 apartments fully paid off keep making property investment mistakes for the last 20 years? Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it.
When I was young, will I ever be able to afford to buy a place in Sydney? And now a lot of people say, will I even be able to afford to rent a place? So the cost of housing has exponentially grown. The Productivity Commission reported a couple of weeks ago that we're losing twice as many people between the ages of 30 and 40 than we're gaining.
Sydney is losing young people aged 30 to 40 years old at twice the rate it is attracting them. The main reason is the high cost of living in Sydney. Many older Sydney residents recall that Sydney was the place where the Australian dream began when they were young. But now, young people can't even afford to rent a property, let alone buy one, as the house prices are too high compared to incomes. To live better, people are fleeing Sydney, causing the city to stagnate. If Sydney can retain young people, they will work, start businesses, open restaurants, cafes, and companies, trade. They will be trading and they will innovate, driving economic development and wealth creation. Without changes, the continued loss of young people will turn Sydney into a retirement village for empty nesters in the near future. To address this issue and slow down house price increases, making home affordable for young people, the New South Wales government is taking action from the supply side. The first step has already been taken.
3 new mini-cities to be built in Sydney's north and northwest, with tens of thousands of new homes close to train or metro lines.
They've just decided to establish 3 micro-cities within Sydney, offering 30,000 apartments near train stations in the short term, including 8% affordable housing. This will be fast-tracked under the state government's new planning legislation. All these apartments will be built near transport hubs for shorter commutes to work. Caliville and Bella Vista will provide 20,900 homes near metro stations by rezoning current greenfield land, which will also affect some community-titled properties and standalone houses. Current homeowners will be very happy as their property values will rise. Hornsby will see 5,000 new apartments near the train station by demolishing old low-rise buildings and adding commercial spaces at ground level. This will create a pedestrian-friendly area with shops and easy access to the train station and hospital. Hornsby already had a master plan, but this new plan is more comprehensive, offering more homes, taller buildings, and more job opportunities. Macquarie Park will add 4,600 new apartments. This is no surprise since the area around Macquarie University has been filled with apartments for over a decade. My concern is whether public facilities can handle the sudden population surge, including hospitals, police, supermarkets, kindergartens, and transportation. The state government has not provided specific solutions. Local governments in these planned areas can only voice suggestions as these are state government policies, leaving them with limited power. Currently, Caliville and Macquarie will be more convenient locations for residents as they are on the metro train line. In August, the Cross Harbour Metro line will open, providing direct service to the city centre from these stations. Hornsby, not being on the metro line, may face more challenges in attracting commuters. These 3 locations are filled with apartments for a long time, with basically unlimited supply potential. The state government's vigorous promotion will lead to a surge in apartments in the coming years. But is this good or bad? Well, it depends on who you ask. For first-home buyers, it's perfect. Currently, there are very few choices for first-home buyers. While they earn a decent salary, they can't afford a home due to the supply-demand mismatch. With the surge of homes hitting the market, prices won't rise as fast, making it easier for people to buy homes. Young people will have hope, stay in Sydney, and contribute to the economy, leading to economic prosperity. For investors, however, it's not good news. We all know the quality of New South Wales apartments. After industry reforms, the ICIRT rating system was introduced to rate builders, ensuring better construction quality. But in my view, this system either works perfectly or fails collectively. Before the Olympic Park building scandal, no one believed some Australian builders would cut corners on construction. ICIRT aims to restore confidence, but its effectiveness is hard to tell. For Sydney's building quality to be trustworthy, it needs to be like Canberra, where the directors of the building companies are personally accountable for the quality of their job for the past 10 years. This new Canberra law ensures developers and builders can't cut corners. I wonder if any agent is still promoting apartments as great investments. Can apartments appreciate in value quickly? Can investors buy apartments for rental income? What about short-term rentals? The future is uncertain, but I have a real-life example to clarify these points. This case spans 20 years of Australian apartment investment and 7 years into the future, involving almost an entire investment journey up to retirement. This client paid over $1,000 for a 1-hour consultation with me, so make sure to watch till the end. A couple of days ago, someone booked a 1-hour one-to-one consultation with me. Let's call him Mr. Wong. After booking, Mr. Wong sent me a lot of information about his properties, loans, current financial situation, and the future goals. He's currently single, no kids, and unemployed, living off rental income. His goals are to make more money, pay less tax, and repay his loan early to retire in Gold Coast. Everything seemed normal until I saw the property details. Mr. Wong has 8 properties, all apartments, 3 in Sydney, 4 in Melbourne, and 1 in Gold Coast. The purchase dates range from 2002 to this year. The first 7 properties are fully paid off, but he took a $1.5 million loan to buy the Gold Coast property, expecting to settle in 2026. This 8th property, being built by a renowned developer, is a 2-bedroom high-rise apartment facing the sea, perfect for retirement. However, from an investment perspective, all 8 properties have issues. Let's see what they are. In the consultation, I appraised the first 7 properties, considering current rents and various expenses. Using our model, I found the gross rental yield ranged from 3.9% to 8.4%. These yields are decent for apartments, but a huge issue is the property's age. Mr. Wong has held these properties for a long time, for over 20 years to at least 7 to 8 years. Maintenance fees and strata have been rising almost every year. Without considering mortgage interest, the net rental yield drops to 2% to 6.6%, below average for apartments. And I haven't even factored in interest payment. Moreover, the capital gains range from 1% to 4.7% annually, not even keeping up with inflation. Even if market prices rise, the value change is minimal. We also observed that high rental yields correspond to low capital gains and vice versa, validating our investment theory once again. Seeing my analysis, Mr. Wong was reluctant to accept it and argued his properties were excellent. I asked what made them excellent. He said location, neighbors, and layout were great. I added, everything is great except the investment returns. Asked him if he knew the current bank deposit rate. He said 5.5%. Then came the harsh truth. I told him that if he had kept his cash in the bank, he'd earn more without paying stamp duty, land tax, or selling agent fees. He was speechless. The problem is clear: no mortgage. We previously analyzed that in Australia, property investment without mortgage is less profitable than buying ETFs and stocks. Mortgage amplifies returns, while loan on a financial product is risky and difficult to obtain. Margin calls can wipe out your investment. Property loans have low interest rates and are the cheapest leverage available to ordinary people. I'm not advocating excessive leverage, but appropriate use. Envision membership investment planning, cash flow analysis, and risk control are crucial to ensure stress-free, long-term property holding, avoiding forced sales during market downturns, which turn paper losses into real losses. This risk control should be part of every investment portfolio. Mr. Wong did take out loans, but didn't use them wisely. He mortgaged 3 Melbourne properties to get a $1.5 million loan, kept the cash in an offset account, and planned to settle the Gold Coast property in 2026. The developer is renowned and offers long-term rental management. It sounds good, but the hidden pitfalls are hard to see. Let's start with the loan. The purpose of a loan is to use low-cost funds for higher returns. Mr. Wong borrowed money at 6.5% interest rate, so these funds must yield higher than 6.5% to make sense. The property's current market value is about $1.8 million, with a rental appraisal of $1,200 per week. After paying holding costs including maintenance fees, strata, council, and water, any positive cash flow would be a win, but I doubt it. Some might argue about capital gains, but the Gold Coast property market is unique, with large price swings than any other Australian city. It's hard to predict future price increases. For long-term rentals, if the property is managed by someone other than the developer's subsidiary, the developer has an incentive to cause trouble since they manage the building's property and don't like competition. Recently, the developer has been less aggressive, but this could change. For short-term rentals, getting an Airbnb in Gold Coast through proper ways is nearly impossible. You need to apply for a permit from the Gold Coast City Council, which involves the town planner charging several $1,000s. The council charges a $7,000 to $9,000 fee with no refund if rejected. An approved property faces a 70% increase in council rates, adding thousands to annual holding costs. The informal way is to skip the permit, start short-term rentals anyways, manage well without complaints, as the council relies on reports, otherwise they will never check on permits. If the property manager doesn't do a good job and the tenants are noisy, parking in the wrong spot, the neighbors will report them to the council. Then you will receive a show cause notice from the council. If you still operate and do not stop with multiple notices, you will get a $1,500 fine. This is why only about 10% of short-term rentals in the Gold Coast have permits. The developer's control of the building's property management means they can report unlicensed short-term rentals, making it difficult for owners. Although recently they've been less strict. Mr. Wang's plan to rent out for 5 years and then retire there may face negative cash flow and uncertain capital gains. Apart from investment decisions, Mr. Wang's choice of professionals also has issues. His accountant is also his mortgage broker, which raises concerns. While some accountants handle loans well, it's rare. Their primary focus on accounting means they may not keep up with the best loan products or solutions, unlike professional brokers. The main benefit is the ease in packaging loan applications. The accountants already have your material. Mr. Wang's accountant also advised setting up a self-managed super fund and contributing to it annually. Setting up the super fund, annual tax, and audit arrangements are within the accountant's scope of business, but determining the best setup and contribution is a financial planner's job. This accountant's advice is non-compliant and could cost the client money. What struck me was Mr. Wang's decision to take a loan and pay interest to offset rental income and reduce taxes, likely the accountant's suggestion. Reducing taxes by incurring more interest expenses is not logical at all, as it means spending more to save less. This mindset shows a lack of investment sense, especially since the loan wasn't used to generating high returns. Part of my suggestion to the client was either pushing up rental returns through short-term rentals to beat inflation or selling most of the properties. Get the cash released and buy better investment properties. The whole idea is to use capital more effectively and mortgage more productively. I'm not saying apartments are not good. They just don't suit most people who want to build up equity and an investment portfolio. For investors who just start on property investment, it's generally better to hold high-growth, standalone houses and add more cash flow properties near retirement. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.